Good afternoon, and thank you for joining us for the 65th webinar in the Offshore Wind series, Learning from the Experts. I am Kevin Flynn, Project Manager with NYSERDA's Offshore Wind team, and it is my pleasure to be joined today by our expert, Philip Bassil. Before I introduce our speaker, a few reminders for participants and some background on this webinar series. Next slide, please.
There was a typo.
Firstly, if you are experiencing any technical issues, please contact Ayla Merwin at the email address on the bottom of this slide. This webinar is being recorded, and the recordings and presentation slides for all webinars in the Learning from the Expert series are available on NYSERDA's website at the address on the slide. All participants have been muted. We will have time for Q&A following the presentation, so please use the Slido feature to submit your questions. Next slide, please. New York State working to advance the responsible and cost-effective development of offshore wind as part of a diverse energy supply. Offshore wind is a critical component in achieving the state's energy reliability and decarbonization goals. While offshore wind has been providing clean energy to other parts of the world for several decades, this industry is brand new to New Yorkers. To provide interested stakeholders and members of the public with accessible, impartial information and opportunities for engagement on specific topics of interest, NYSERDA is hosting this educational webinar series called Learning from the Experts to connect the public with independent experts in key topics in offshore wind. We endeavor to select Learning from the Expert speakers based on their expertise, not necessarily for an alignment of opinions with NYSERDA or the state of New York. Please note that the views and opinions expressed in this presentation are those of the presenter. Next slide, please. Okay, and with that, it is now my pleasure to introduce Philip Bassil. Philip is Managing Director of Northgreen Capital, a strategic M&A advisory firm specializing in offshore wind and sustainable energy infrastructure. With over 2 decades of experience across Europe, Canada, and the US, Philip advises institutional investors, developers, and strategics on structuring, financing, and executing complex infrastructure transactions. I will now hand things over to our speaker.
Thank you, Kevin, and thank you to NYSERDA for the entire team for the invitation. I commend you on the important work that you do on behalf of the entire industry. So today we're talking about port infrastructure structuring and financing for offshore wind. This is a critical and complex topic, especially in the current environment globally, and more notably in the US under the current federal administration. It is very much a chicken and egg problem. Without ports, offshore wind projects cannot be built. And without a pipeline of procurement opportunities for offshore wind, ports cannot be financed. This is the great paradox that we'll be discussing today. The good news is that it is possible to structure and finance ports for offshore wind, even in the current environment. Ports are more than just a piece of the puzzle. They truly are enabling infrastructure that serve multiple uses and are really 50 to 100-year assets. And that's a really important point I'm going to come to in the slides in a moment. That's how we should be looking at these infrastructure facilities in order to finance and structure them from that perspective. The important thing is that port infrastructure is very much needed. So there is a need. It's a massive need, and there are massive constraints and shortages of the right infrastructure, both in the US and in the markets globally. Tens of billions of dollars, some estimates are as high as 100 billion in the US, are required to develop and upgrade port infrastructures. As Kevin mentioned, my name is Philip Bassil. I head up Northgreen Capital. We're a specialized M&A and finance firm focused on the offshore wind ecosystem, which of course includes ports. We do a lot with ports, both in Europe and North America, as well as other select mature and emerging markets. I was recently invited to the Port of Bilbao, which is another great example in Spain, of a port that implements exactly what we're talking about here. I'll do my best to cover some of the key elements of this very important topic in the limited time, and then we're going to have a Q&A at the end, but also feel free to reach out to me directly after the webinar if you have any questions. With that, if we can move to the next slide, Ayla. So I gave a little bit of background. I'll give some additional introduction, and then we'll move into kind of level setting, talking a bit about the types of ports. We have a diverse audience here, is my understanding. So we'll talk about some of the different functions of ports and then the upgrades required for both fixed bottom offshore wind and floating offshore wind, which are very different from a port perspective. We'll talk about the capital stack and the available types of capital and the ways of structuring these sources of capital in order to finance the port infrastructure. And we'll also discuss what makes ports bankable, the revenue diversification and the multi-use aspects. And we'll give a couple of examples to give you a sense of what's happening globally in these type of ports. And then we'll end it with some of the most common mistakes and the risk mitigation strategies for both port owners and port operators, and more broadly the sector. And then we'll go into the Q&A, where I believe Kevin will come back to lead that. With that, we'll go to the next slide, please. So a little bit about Northgreen. As you can see in the center, we're primarily focused on the European market and North American markets, as well as select markets globally. We're active across the offshore wind ecosystem, which of course includes transmission and port infrastructure. We've been active across numerous jurisdictions in a number of gigawatts. With that, we'll go to the next slide. When we talk about the offshore wind ecosystem, I just wanted to make sure we have a visual. When we talk about offshore wind, it's very different than onshore wind, as you may know, including all the elements you see here on the screen, both the substations, the subsea cables, but all the way to the grid onshore. And very central to that is the port infrastructure, both during the construction phase, but also the O&M timeframe, which is typically 25 to 35 years for these projects. The grid is also a very important part of this, and the obstacles in terms of constraints. We're not going to cover grid today. We're going to stay focused on ports. Next slide, please. We also speak globally at different events in terms of thought leadership across the sector. You see some of those here. So if we jump into the next slide, why port infrastructure financing is important for offshore wind and why it matters now. As we all know, the federal government in the U.S. Has canceled and put a stop to future awards of offshore wind. Although we do have about 5 gigawatts under construction in the U.S. currently, it remains important to make sure the port infrastructure is ready. And according to some estimates, up to $100 billion in infrastructure requirements up to 2035 are required. Of course, the 30 gigawatt target by 2030, although it will not be accomplished in that time frame, we believe that offshore wind is an inevitable part of the energy mix, national and energy security in the U.S. And that might be an extended time, but we do believe there's a major role for offshore wind. And the next one is really important. 70% of offshore wind projects, LCOE, levelized cost of energy, is influenced by port logistics decisions. I don't think enough people realize that. And it takes about 18 to 36 months to really get the port infrastructure ready for these offshore wind projects. So really, this is an important window to really be mobilizing both stakeholders and capital, as well as states and different sources of private and public capital to mobilize and develop these ports. They're no longer isolated pieces of infrastructure, and really the port decisions that happen in the near term will affect the economics of future offshore wind projects. With that, we'll go to the next slide, please. There were, many ports on the East Coast and a few on the West Coast identified. There was about 679 million of capital that was allocated in terms of U.S. federal funding that has been now shifted away from those 6 states, including New York and California, due to the shift in priorities of the administration, which makes private sector and state-led financing even more crucial for these ports at this time. Next slide. So in this section here, we want to talk about level setting, the different types of ports, the functions, and then also the required upgrades for these ports. Next slide. So here we focus on 4 primary archetypes. The marshalling and staging ports, these are used for pre-assembly, component storage, loadout, installation vessels, and then they also encompass laydown acreage, as well as quayside load capacity. Offshore wind components are very heavy, which makes them uniquely, have specific requirements we'll talk about in a moment in terms of load capacity. The second type that we highlight here is more kind of going up the value chain, manufacturing and fabrication across monopiles, jackets, blades, cables, and other industrial infrastructure for these projects that require deep berths. Those first 2 elements are primarily through the construction phase of the project, which could be anywhere from 24 to 48 months. The next archetype is the O&M service base, and these are longer term. These would be for the life of the project, to do the operations and maintenance, to also manage crew vessels and other requirements, parts and storage over the 25 to 35-year life of the projects. And the last one, which is becoming even more important in this environment, is multi-use ports, which include other uses than offshore wind, specifically around industrial, cargo, ferries, manufacturing, and there's a significant list, break bulk, ro-ro, and other uses as well. And that has become really critical in order to advance this expansion in infrastructure. So let's talk about, on the next slide, the type of upgrades required for offshore wind. And I touched on heavy lift capacity here briefly, but to look at a bit more of the details, so 4,000 to 6,000 pounds per square foot is really a significant requirement for offshore wind, and also a significant capital expenditure for ports to meet. Yard storage and other uses, as you can see here, in addition to laydown area, are critical. And then as you get into infrastructure, manufacturing, building, logistics, those are additional upgrades. The deep draft berths are also critical for the vessels, the installation vessels, and they are required, especially on the East Coast. On the West Coast, we have deeper ports, of course. Grid and shore power is also critical to upgrade those infrastructure, as well as water capacity. And then the last one is last but not least. It's the environmental permitting, which takes a significant amount of time, sometimes as long as 7 years. That is one area that we feel that port owners and operators neglect to start early, and that's one of the recommendations that we would have. There's also funding available to de-risk and do pre-feed studies for specifically those elements in order to allow the permitting to advance. On the next slide, we'll get into the capital stack. So where are the various sources of capital? We talked about the ports, the type of upgrades they need. Now, where would the capital come from? We talk a lot about the capital stack when we work with clients. And in addition to public grants, which are available at regional levels, state levels, and still, believe it or not, some available at the federal level, although not directly for offshore wind, some adjacencies. We'll talk a bit about those. Private equity, project finance, green bonds are also other sources. And really, those markets have changed recently, and we'll talk a bit about the cost structure there. We reference here a three-step model for de-risking the capital stack to make bankable port infrastructure. And the first piece that we highlight on this slide is the wet infrastructure, and really leveraging public capital to de-risk that element. So, really, the foundation, the dredging, the breakwater, the quaysides, the quay wall, those are critical elements that will help private capital come in because they've seen that piece being de-risked. And the cost of debt could also be reduced significantly by using those public sources of capital. The second piece we talk about is really synthetic equity, or structuring the right agreements with partners to de-risk the project. And really, structuring bankable commercial agreements is central to this piece, especially working with strategic partners and ultimate tenants and clients. And some mechanisms include take or pay structures to allow project risk to be reduced and then create bankable assets. And the last piece is really the view of looking at these ports, not just as infrastructure, but really enabling platforms and multi-purpose platform. And this is the really one of the key messages of this webinar is really multi-use ports is the way forward in order to achieve the upgrades and the requirements for offshore wind. But it's in the context of multi-use. And with that, I'll move to the next slide. So, we've had quite a bit of change since, 2020, 2022, where interest rates have increased significantly. Here, for example, we talk about a 500 basis points change in the cost of capital. We've also seen construction inflation across steel, concrete, and many of the civil works elements that are central to these upgrades that these ports need. And then specifically here in the US, we see that the view on the pipeline has had significantly more uncertainty added to it with the current posture from the federal administration. So we highlight on the next slide the 4 bankability drivers, and specifically, if we go to the next slide here, so really underwriting the revenue streams, and that's really what lenders are looking to do. They're looking to finance the revenue streams, not just the facilities. And in that context, having the anchor, credit-worthy developers is, of course, ideal. But in this environment, it would be also valuable to have other users as anchor tenants. We'll talk about some of those examples shortly. In-water works, also, completing the dredging and the marine civil works before the vertical construction really removes a lot of that source of uncertainty around cost, and helps lenders see the de-risking of the projects. Permitting is also one I highlighted earlier, but it's really key to achieve the approvals and the permitting milestones across the various elements, including the states, that really allow fully permitted ports to be underwritten by lenders and investors. If we talk about the revenue diversification models on the next slide, the multi-use model, is really key here. The ports that attract the best price capital are not pure play ports. They are, resilient by design. And, some of the, if we go to the previous slide, actually. Oh, okay, I think we're missing a slide. That's okay. The port revenue stack is one of the slides here. We really talk about 4 tiers. The first one being the offshore wind construction phase, really, which is a 3 to 5 year time frame of active construction. It's an active construction window of the project. And then the following, the O&M piece, which many ports do not look at early enough, is the 25 to 35 year phase of the project. Having those constructs in terms of commercial agreements are ways to de-risk it before the O&M actually starts. The third element that we highlight is adjacent marine commerce, whether it's cargo or research vessels, in terms of baseline utilization to allow the debt service coverage to be achieved despite the volatility. That's the slide, yes. Despite the volatility in the offshore wind projects coming down the pipe. And then the last tier is really around creating clean energy hubs, but also leveraging, currently we see significant investment in military and defense spending that also have similar uses for ports, data centers, AI, and other adjacencies. Manufacturing is also high on the agenda, and those are also uses that could leverage similar infrastructure at the ports, which would allow these ports to advance and be ready for offshore wind in a few years. The other thing I want to highlight is it's important to note that port structuring and financing is very site-specific. It's based on the location of the project, but also the other characteristics, adjacent industries and adjacent users or others that can be attracted to that specific location. So that's really key to look at the specifics of the port when you're doing this exercise. For example, I mentioned the Port of Bilbao earlier. The Port of Bilbao is a great example of a mixed-use port that has attracted more than 50 terminal operators. And they have uses from oil and gas, anchored by Repsol, which is a strong long-term tenant, but also all the way to offshore wind manufacturing and tenants like Siemens, Gamesa, GE, and some of the foundation manufacturers. On the next slide, we highlight the difference in the DSCR, the debt service coverage ratio, and in this chart here, you see the volatility of an offshore wind project, a pure offshore wind project port in red, and the coverage for the debt coverage has significant volatility depending on delays and the timeline of the project. Whereas a multi-use, as you can see here in green, has a more stable DSCR coverage. This allows for cheaper debt, lower risk and perceived risk by both equity providers and debt providers. So really having that baseline utilization piece also the pipeline hedging to really understand the view for the ultimate offshore wind users, and then allowing for longer tenor debt and lower cost of capital. We also highlight here that working with communities and the workforce also is a key de-risking element for the project. Next slide, please. So we thought we would add a few examples here, and you know, the Port of Esbjerg is a really good one. So the Port of Esbjerg in Denmark handles about 80% of the offshore wind projects in Europe. It's the #1 offshore wind project globally in terms of volume of components. Has managed over 30 gigawatts since 1990 and impacts about 4,500 jobs. And the way, you know, this has taken time, of course, and patience is a key ingredient in port infrastructure. Initially, as a fishing village, you know, Esbjerg was, you know, servicing that community and evolved into a multi-use port, offshore wind being quite central to it, and more recently, military support in NATO installations and support for those activities at the port have allowed it to attract both state funding, but also private capital in the form of pension funds and other sources of capital from the EIB and other EU funding sources. And really, I think the key lesson here for U.S. ports is that the sequencing matters. So the public investment really came in early, and it helped de-risk the wet infrastructure, the heavy quayside capacity, and created the platform that attracted the private capital and the anchor tenants. So, you know, really important lesson here is to leverage public infrastructure investments first, and then attract the build out. And typically that's, you know, it's the you know, above ground infrastructure build out, whether it's manufacturing, warehousing, cranes and other investments on the ports, as opposed to the dredging work, the quayside, and those elements that would be better suited for the public investment to de-risk. The next example here is on the next slide. We have, oh, this one, yes, the $400 million investment in the port, the Abel Seaton port in the UK, which really leveraged a really innovative mechanism that the UK government used to help fund this, which really was around tax incentives. So it was it's a free port, and there are a number of these free ports in the UK that provide tax incentives as a structuring tool. And that allows for blended financing for both institutional capital and private equity to come in alongside those de-risking elements supported by the government. So in terms of lessons for US ports here, you know, it's really the opportunity zones, the federal enterprise zones that are currently do exist. So structures do exist in the US, leveraging some of those to really improve both returns and reduce the cost of capital to really make projects that might not be fundable become fundable. We have two more examples I wanted to highlight just to give a sense. On the next slide is the port of Ulsan in South Korea. And this was KDB played a major role here. That's the Korean Development Bank, was the lead lender that attracted both private investment, but also helped you know, private developers and users see that there was a credible entity backing the project to allow for both heavy industrial port use for petrochemicals in addition to offshore wind, which allowed that shared infrastructure to reduce the cost. So again, there are examples and opportunities for U.S. ports to leverage state-backed blended structures to take advantage of current uses, whether it's break bulk or manufacturing or other uses that would fill the near-term use until we see more certainty on the offshore wind pipeline. And the last case study we want to highlight is on the next slide, the New Bedford Marine Commerce Terminal in Massachusetts. And again, this was one where the Commonwealth of Massachusetts invested in the marine components to de-risk the project, and then long-term lease from Vineyard Wind and other developers allowed the port to retain ownership, but also de-risk the private capital coming in by having those leases from the developers. Again, this is one where it's a blend of mixed use, but also public and private capital coming together to reduce the risk and ultimately reduce the cost of capital to allow the project to be developed. If we go to the next slide, yes. So practical. So really here, we want to talk about some of the mistakes and some of the pieces, some of the advice that ports that are just beginning can take. So on the next slide, and this is something we see some of this in the reverse order when we're working with port clients, but site control is really key. So securing long-term land and waterfront leases is really critical to start there. Without site control, there's no asset to finance. And so this is the first legal prerequisite for any lender. The second point is also often missed and delayed. The geotechnical studies and the surveys that need to take place to establish a baseline for environmental and other geotechnical elements is really key to de-risk the project further. The third piece here references the market assessment for offshore wind. I would also, in the current environment, encourage ports to look at this more broadly and really assess the local geography around the port, the industries near the port, and others that could be attracted to that location while doing their market assessment on potential tenants, potential partners, and the ecosystem to drive economic development and jobs at that location. Permitting, again, is one that typically takes quite a bit of time, as long as between 3 to 7 years. But there are many stakeholders, including state and local governments involved, the Army Corps in this case, CZMA, and others, and that is something that really should be initiated very early on. And again, there are still funding mechanisms available there, in some cases grants or forgivable loans that will fund that pre-feasibility work. And then, starting conversations, the fifth one here, starting conversations with developers is also critical, even though in the current environment, no new projects are being awarded, but really engaging in an informal way with the developers early is really critical in developing those relationships and letting them know the capabilities and the plans for the port is really critical. And in addition to that, other users, whether it's manufacturing, semiconductor, data centers, or other users that could be potential longer term tenants that could take advantage of the upgrades, are also important to engage with. So on the next slide, we highlight the single greatest risk and how we address it. So really, the biggest risk right now in the U.S. is pipeline concentration certainty. We see a lot of projects that were effectively depending on one or two offshore wind projects to be permitted, financed, and built on schedule. We're in that core concentration risk, and really having the multi-use, multi-tenant strategy is one way to mitigate that. We touched on the O&M opportunity as well, moving that earlier to have a stable, longer-term use at the port facility. And then geographic diversification, depending on the port location, there are other opportunities around that to span multiple development zones, not just wind projects. And then really the financial modeling to stress test the underwriting if there are delays in projects or tenants, development opportunities. How does that impact the debt coverage ratio and the capital structure of the project? So on the next slide, the call to action and really what differentiated by stakeholders is, for port operators, begin site control, geotech studies, permitting now, even without developer commitments. The clock is already running. For developers, really structure and anchor tenancy agreements to be bankable for port owners is really critical. The LOI or lease is the primary lending collateral. If it was for investors and lenders, really evaluate multi-use ports as an underappreciated infrastructure credit. Blended finance structures can create attractive risk-adjusted returns. And that's really important for lenders and the investor community to start valuing the multi-use aspect of offshore wind ports as really key at this time. And for policymakers, to examine whether the state and federal incentive programs are being stacked optimally. There are still current programs, both federally and at state level, that can be applied and can help de-risk these projects. And really getting those focused on the early work to de-risk a project is really key to unlocking the private investment at scale. On the next slide, I won't go through all of them, but we do highlight some programs that are still exist, both federally and at the state level. We highlight specifically some in New York and then other states as well. And at the federal level, for example, manufacturing, production tax credits, there are still some grants available and other programs. I won't go through all of them here, but you'll have access to these slides after, I believe. And so on the last slide, if we just highlight the concluding observations. Again, lenders underwrite a revenue stream, not a facility. So really structuring the right contracts and having the right construct for commercial bankable agreements is really critical to attract both public and private capital. The macroeconomic environment has fundamentally changed, and the repricing of debt has increased, but also the projects that survive are those that have multiple sources of revenue and multiple tenants. Multi-use ports are more financeable than pure plays. I hope that message has come across. Really diversifying is the strategy. It's not a compromise. And then the importance of really starting the geotechnical, the permitting, the market assessment, all those elements early on is really critical to help de-risk as you get into the capital raising part of the project. And then the last one around pipeline concentration risk, that is really the single biggest threat, and really diversifying and structure bankable agreements is really important to survive any delays of a specific project. With that, thank you, and I think we're going to have a Q&A session now.
Awesome. Thank you so much, Philip. As some questions file into us, I just wanted to mention for those interested to please check out the Exco podcast hosted by Philip, which contains a bunch of additional relevant information on this topic. There's a bunch of great interviews with ports that are doing a lot of work along these lines. So definitely a resource that would recommend checking out. And as you are looking at this slide, you can scan the QR code here on the screen and be brought directly to that podcast. All right, and now I believe we have some questions coming in. So Philip, the first one, and as I'm looking through it, there was a lot of information that was covered there. That was just a really great overview, but part of it is we talked a lot about DSCR specifically and the importance of it. I was wondering, just for the entirety of the group that's kind of listening here, if you could just give us a brief overview of what that term is at its most base level and why it's so important from the lender's perspective and from the financing perspective when we talk about these ports questions.
Yeah, that's a great question. So the DSCR, the debt service coverage ratio, determines how much debt or how much capital a project can raise. And really, that's why I was referring to those structure and the right contracts that would allow for a baseline of revenue and profitability to the port that can be seen by lenders as an ability to service debt at a certain minimal level, despite the fluctuations. So that DSCR is a measure, and sometimes some lenders would require 1.2, 1.3, or 1.5, as high as 1.5 in some cases, times DSCR to allow them the comfort to see that there's a long-term source of getting repaid and reduced risk to their loan.
Got it. Right. So when we talk about, and I know that you had mentioned in the slides, like 1.0 DSCR, we really want to make sure that we're above that. Basically, what we're saying, if I'm understanding correctly, is in any year, we need to make sure that the cash from the revenues at least match, the interest and the principal that we have to pay in that year. And it's hugely beneficial if that can come from multiple revenue streams, because offshore wind, as we've seen, is a little bit lumpy.
Exactly, and the higher the risk or perceived risk, the higher that number would be. So, 1.2 might be on the low end. You should aim for more than that. Maybe closer to 1.5 to allow comfort and reduce the cost of that capital as well.
Gotcha. And so when we're looking at that, right, the DSCR piece, what is the benefit of reducing that? Does that reduce kind of the costs associated? Does that allow us to attain more capital?
No, great question, Kevin. So the higher that number is, the better the port is positioned to service its debt. So it actually reduces the interest rate, the cost of capital that the port would be charged. So really, you want to as high as possible DSCR, debt service coverage ratio, in order to allow lenders to feel comfort that even though there might be delays or some cancellations, the port can still service its debt.
Gotcha. Okay, that's very helpful context, and thank you for providing that one. And then kind of the next one, also for those of us who are not as familiar with kind of the financing process for a port, I know that you mentioned a lot about doing in-water work first and that kind of de-risking the project. I was wondering if you could maybe speak a little bit more to why that de-risk the project. Is it because there's variance in costs, or what's kind of the background there that you see?
Yeah, what we see is in water, so there's quite a bit of unknown. So until that work starts, that there is uncertainty in terms of the depth, the context, the structure of the soil, and so on. But typically that is dredging work, quayside, quay wall. Those are expensive pieces of construction, and there is risk with that when it happens. But if it's already been designed and already has started construction, then again, the other elements are seen as less risky.
Gotcha. Okay. Very good to know. Next question we got in here is, what risks arise if port infrastructure development follow offshore wind projects reaching FID?
Yeah, that's a good question. So what we've seen is, it's been kind of reverse, where port infrastructure has been developed after an offshore wind project has committed to the port, which is the ideal scenario, but it's actually in the reverse order. Port infrastructure takes anywhere from 2 to 7 years to develop. And if an offshore wind project that wants to use that facility has to wait that additional time, there's additional uncertainty, but also additional costs that are incurred, both to the project and the port. And then there's also project on project risk, because you have to finance the port, but you have to finance the offshore wind project. So ideally, you have the port infrastructure ready, and the project selects a port that can meet its requirements, both load capacity, storage, manufacturing, what have you. So really, it's critical at this time to have that port infrastructure accelerate and be ready for the offshore wind build out, as opposed to wait for the projects to take financial investment decision, a final investment decision before you start building a port to meet that need.
That's super interesting. Haven't really thought of it that way, but project on project risk, like you mentioned, it adds costs, I would assume, on both ways, on the port itself and then also on the offshore wind project. So
absolutely, yeah. I mean, anywhere there's incremental risk, anywhere you can de-risk is a good opportunity to reduce cost of capital, plus attract a larger pool of capital providers, whether it's pension funds, private equity, banks, lenders, private credit. So there is no shortage of capital. Maybe that's one thing I should have said, is there is no shortage of capital for this type of infrastructure. It's really all about the structuring of bankable arrangements that allow that capital to flow.
yeah. So I guess along those lines, what would you say is kind of the best way to find a strong port partner to jointly build a port?
Yeah, and that's, yeah, we do a lot of work in that. So we talk about, and maybe I'll dive in a little bit. We have a framework that we use, and ROI is referred to as return on investment. But the way we look at it is, if our ROI, result, options, and impact. So if a port operator or owner is really looking at their ultimate result, what's the result they're after, and really defining that very well. Based on that, look at what the options are. There are multiple options typically available, and then analyzing each one of those options to understand the impact on that result based on those options. So that's the ROI initial piece of the framework that we look at. Then we look at, we call it ADE, so assess, de-risk, and execute. So you're really assessing each of those alternatives and then identifying de-risking or mitigation strategies for each of those, and then you'd execute. So if you go with a well-defined framework, and this is, I tried to cover it in a very short time here, but happy to discuss it in more detail, maybe offline, but really having a framework before going out there to identify a partner is going to help significantly, both to understand what kind of partner the port is looking for and what kind of partner is ideal for the ultimate result or outcome that the port is looking for. And then again, it's leveraging relationship with industry people that, there are, of course, Northgreen can help, but there are others that have relationships and know which partners are looking for what kind of port partnership opportunities.
And I think that this kind of leads into the next question that we kind of received, which is, there's, as you highlighted, there's a ton of different ports that we're talking about here when we're talking about offshore wind ports, but also just infrastructure at a whole from the port. Some ports that we're looking at, which may be smaller, may not see themselves as, I might not be able to, produce a nacelle or something along those lines at my port. But kind of that supporting port infrastructure for some of the small, how would you address something differently if it's for, a smaller port that's looking to kind of move into the market and support some of these larger projects?
Yeah, that's a great question. So we're doing some work in Europe, and I'll give you an example. So France has big ambitions to award 10 gigawatts of offshore wind in the next round, 5 gigawatts of fixed bottom and 5 gigawatts of floating. And so what we've seen there is the ports are really working, in cohesion and collaborating together, where smaller ports can address different needs, and together they can actually offer a package solution to the industry. So really identifying the competitive advantages, again, the geographic and industrial elements that position a port best to address a certain piece of components or piece of the ecosystem is really key, and then working together in collaboration. And as you mentioned, on the podcast, my podcast with the president, Dennis, the president of the Port of Esbjerg, we actually talk about that, and that is also happening in Denmark across a number of ports, both in country and beyond. They're working with Poland and others. So collaboration across ports to leverage each of their strengths to address the needs of the industry is really critical.
Yeah. And kind of along these lines, do you see similar port infrastructure constraints in Europe? And what advantages are they leveraging to secure financing, would you say?
Yeah, absolutely. I think we see similar port infrastructure constraints in most markets, if not all, but definitely in Europe and North America. And what we see in Europe is they've had a little bit of a head start, as we know, in offshore wind.
Yeah.
So there is a significantly more dense, whether it's the North Sea, for example, the North Sea, of course, they have a significant amount of operating projects. So there's a big need for O&M and supporting services, but there's also significant scale and alignment in terms of getting the industry moving. So there's more scale in terms of opportunity for those ports. There's also more alignment across countries, whether it's Denmark or France or Germany or the UK. Of course, the UK we see, as the largest market outside China for offshore wind. And really we've seen alignment in scaling the industry. So I think the advantage in Europe, even though they do have those constraints, they have a bit more visibility on the pipeline. And then the second advantage that they're leveraging is multi-jurisdictional funding sources. So, for example, there are in-country sources in Europe, but there's also the EIB, which is across the continent, that's also quite heavily involved in this enabling type of infrastructure.
Gotcha. And something along those lines is kind of the next question that has been posed to me, I think, in terms of aligning both across, multiple stakeholders, but also potentially multiple players in the capital stack is, the timeline for these investments has always been a challenge. Can you advise if the private capital side should be involved during the public capital raise, or is the private capital only de-risked after any public funding is achieved?
Yeah, that's another great question. We believe the earlier the better. So if there's alignment on the requirements of the private capital, it is helpful to the public capital raise, but also vice versa. So they really go hand in hand. To support the public capital commitments, having private capital in the conversation early is really critical.
Yeah.
And we believe that's probably one of the mistakes where, private capital comes in too late, or I guess, comes into the conversation after some major decisions have been made, where you'd have to unwind or redo some contracts or make things more bankable. So definitely earlier conversations is key.
And would you say that getting that private capital involved is like when sometimes things have to be unwound? Is that because there was a misunderstanding around, kind of required returns that folks might need, or was it more so around, the process and the diversification of risk across different revenue streams? Like, what would you say is like things that people should definitely be on the lookout for, and kind of starting those conversations early if they are looking to get private funding involved?
Yeah, I mean, there are examples, whether it's concession agreements or step-in rights, or various de-risking components to structuring these deals with multiple stakeholders, which ultimately trickles down to the cost of capital and the comfort of the private capital. So it's really intertwined. So it impacts a lot of these different elements.
Good to know. And then I know that hopefully we have time for one more. We received this question. It's what kinds of upgrades are needed for fixed versus floating offshore wind infrastructure, and what are the ranges of costs associated with them? I know that, kind of what we're looking at a lot of in the US are fixed, but when we get to that floating stage, how are the costs going to be changing, and what should folks be aware of as they start to build in this infrastructure over the next couple decades?
Yeah, again, in the US, I mean, on the East Coast, primarily you're looking at fixed bottom, although there is some, sort of floating as well. But on the West Coast, it's all floating. So, it's very different requirements for ports. Of course, with floating substructures and the foundations, those platforms are built onshore, and the turbines are erected, and so you need wet storage. You need very different type of port upgrades for floating than fixed bottom. So yes, there are significant differences. Costs do vary. Again, location and existing infrastructure impact that. But there are significant differences between port requirements for floating versus fixed.
Awesome. Well, this has all been so insightful. I can't tell you enough. So I'd like to thank Philip. Maybe if we could move back to the closing slides. Thank you so much, Philip. And thank you all for joining us for this Learning from the Experts webinar. A reminder that the webinar recording and the presentation slides will be available on NYSERDA's website. Our next webinar in the series will be on June 3rd. Annika Mathewson with Peak Wind will provide an overview of offshore wind operations and maintenance activities and coordination, including the suppliers needed at each stage of O&M. You can register for future webinars through our events page at wind.ny.gov. And we also encourage you to check out our past webinars in the series on NYSERDA's YouTube channel. If you would like to request a topic or speaker for this series, please email us at offshorewind@nyserda.ny.gov, or fill out our Learning from the Experts survey posted on our events page. Once again, thank you all so much, and thank you to our presenter, Philip, this afternoon.
Thank you, Kevin. Thanks to the team.
Thanks, everybody.